Yeah, I was standing a little bit late, but nevertheless, better late than never. So let's have something to share this morning in a continuation to our class. Okay. So today we're going to look at another indicator. The indicator we're going to look at is the Fibonacci retracement indicator. So we're going to see through how we use the Fibonacci indicators to determine the trend or the direction of the trend, and then possible trend reversal and retracement levels or price levels. So that's what we're going to do. And then also at the same time, we're going to see how we can use it to help us identify those different price reaction levels to established in our margin call drops. So I remain Coach Musa and welcome aboard. Happy to have everyone on call. For those who are always consistent to this class, I'm very happy for you, and they should be equally very glad that you're always part of this class. I hope I'm audible enough. I hope my voice is clear. I hope you can hear me very clearly. So you permit me share my screen and we go through what we have to go through today. Okay. Share this. Hmm? Yeah. Okay, so the indicator we're going to look at today is called the Fibonacci retracement. This is one of the most powerful. This is one of the most powerful indicators as well. That is you always use, or you can use it as a substitute for your trend line. So if you basically don't want to use, you will want to draw the trend line, capturing the different price reaction level, you could equally incorporate in the Fibonacci, and then you'll have those lines automatically located and captured for you. So that means you'll be saved a lot more time for drawing those support and resistance, or identifying those different price reaction level to draw your support and resistance. So the Fibonacci indicator or the Fibonacci retracement tool has two versions, the auto one and then the manual. And okay, so so the auto and the manual. Now the auto is the indicator that upon adding it on the chart, it automatically identifies the different price reaction level and it labels them, or it draws a line horizontally to capture them. But the manual one is the one you use by first of all identifying the area which you would wish to actually focus on in your analysis. Then it will require you identifying what the trend was, okay? And then you actually capture those key swing positions or level, and then you draw them, okay? So the Fibonacci retracement is a trend indicator, okay? It helps you tell the direction of the market. And you're also doing that, it helps you identify possible points of trend reversal, and retracement, yeah? Retracement levels. So it helps you identify those possible trend reversal levels on the chart, and at the same time, it helps you identify those key retracement levels that if at all the market price is in a particular direction, you should be in position to locate tentatively the possible areas to which the market price may pull back before maintaining the previous trend if it is not reversing. Okay. Now the Fibonacci indicator is built on it captures the movement of the market based on the previous trend, or it bases on an established trend. For example, if the market price is if we are having an uptrend which is moving in this manner, right? This is an uptrend, for example. Let me just use this. Let's assume this is a movement that that resulted into a surge in the market price. Then it is in the course of this retracement. We are going to assume that this is an uptrend, right? Now, in an uptrend, we know that we are going to have a movement characterized by formation of higher highs, okay, and then higher lows, right? Where the higher highs will be the peak there, and then the higher lows would be those different price level where the price will be pulling back to before maintaining a previous trend, okay? Before maintaining this kind of movement, those specific price level where the price will drop to before actually going to break structure on those areas where it previously encountered a rejection. So because of that, the Fibonacci retracement will only capture this movement, this established movement, and it will let be this other one which is building up. So by capturing the previous movement, it will help you locate the possible retracement points, okay? Because remember, the price will be retracing, okay? The market price will be retracing or pulling back, but to what price level the market price will be pulling back to is an area that you may not easily know. But what the Fibonacci helps you to do is that it helps to locate, okay? It helps to capture. It gives you those tentative area that the price is most likely going to pull back to before having a reversal to maintain the previous trend. Okay. Now I'm going to use the manual to explain more of these other details. Okay. Let's assume we have this movement. We are going to capture this movement. Just a moment. We're going to capture this movement. We are going to take, for instance, that the price rose from this level, okay, to that level. So if you want to monitor, if you want to draw our Fibonacci, we are going to base on what the trend is. Like in this case, it is an uptrend because there's an expansion to the upside, right? From this point to that point. So it is an expansion to the upside. So it means this is an uptrend. It is an expansion to the uptrend. So it is a bullish movement. So we shall capture this point, this lower point where the price started rising from, and then we connect it to this other upper point where actually the price got a rejection before having this downward movement, right? So that's what we're going to do. So we shall connect this point to that. So meaning we put our fib tool on the lower point where the price is starting from, and then we drag it and connect it to the higher point that has been established, which is the higher high there. Okay, then by so doing that, we shall have the Fibonacci establishing the different price reaction levels, but a movement that will be from 0 to 100. Okay, it will monitor a movement by 100%. That's what the Fibonacci does. It captures the market price movement by 100% before a retracement happens. So because of that, we're going to have these Fibonacci levels established automatically for you, capturing those key price reaction levels in between the 0 and 100. Now, out of the different price reaction level, there are three key price retracement levels that you need to put at the back of your mind. Okay? There are three key price retracement levels, or the price levels where the market price takes pull back to, if at all it is maintaining a particular direction, be it in an uptrend or a downtrend. Like in this case, we are having an uptrend. So we expect the market price to surge, okay, capturing a 100% movement before retracing. And if at all it is should retrace, it must retrace to specific price reaction levels, right? And we said on the Fibonacci, there are three key price retracement levels. They are referred normally to as the golden ratios. Okay? So those key Fibonacci levels are the areas you focus on if the price is retracing, right? That is where you actually focus on. So once that is done, once the price drops to any of those three key price reversal areas or points, it will reverse. And then if at all it is continuing in an uptrend, upon retracing or pulling back to any of those three key reaction levels, it will have to reverse and come and break structure. It will have to break this previous resistance that rejected the price from going up. Once it breaks, then that means this is another continuation of a trend. So it will monitor again the movement from this point of trend reversal, okay, or price reversal upon retracement by another 100%. So it will again begin trending, capturing the movement from 0 to 100 before another retracement is actually monitored, right? So you shall have a moment of a surge and a retracement, a break of structure, another surge and a retracement in that manner. So this movement is what it monitors, okay, while helping you to locate these pullback areas. All right, that's what the Fibonacci does. Now, let's do this. Let's capture this movement. We're going to capture this movement from here. We're going to drag it upwards, and then we connect it there, this point. Okay? So as you can see, this is a 100% movement. I'm using the manual Fibonacci. Okay? I'm using the manual Fibonacci. So I started the movement from here to there. See that? So that means that is a 100% movement. If you check on that, in an uptrend, normally, if the price moves up to that level, if it is pulling back, it marks these Fibonacci levels. But as I said, there are only three key price retracement levels. The areas that we believe that the price tends to pull back to before maintaining the previous trend, or before executing the next trend, okay, or maintaining the previous trend. And these key Fibonacci levels are the 38.2%, the 50%, and then the 61.8%. Those are the key price retracement level. So it means if the market price surges and the movement is by 100%, for the market price to correct, it has to pull back to any of these three. If not at this point, it will pull back to this level. If not at this level, it will have to pull back to this level before reversing to the upside, come and break structure. okay, to come and break structure. That is what it will do. Okay, so meaning that if you want to use the Fibonacci retracement to make entry in a rising market, there are really two key price entry level. There are two areas where you can make entry from. First is when the price is just beginning to rise. That is at this point, at end of this point, okay? End of this area. But that is the first entry areas or positions. Then the second entry position is when the market price is pulling back. You will have your entry point at 38.2 or 50 or 61.8. Those will be your key entry areas. Now, of course, if the market price is pulling back, most of the times people tend to use preset. The best areas to set your to put or to identify and put as your preset would be that area around the 38.2%. If you come across when the market price has dipped below the 38.2%, that means your preset could be set at the 50% fib level. Or it could actually equally be set at this. Now, if you set your preset at 38.2%, of course, at every fib level that is drawn, there is a price that is put in bracket where that line actually crosses on the price line here. Okay, this is a price line, right? So where this line would have run, because this we assume that this is the clear line, but then the rest are imaginary. We can't see it. But exactly this line here, through the imaginary line, will come and capture on the price line. That particular point where it is going to touch on the price is that is the price that is going to be indicated in bracket. So those fib retracement levels captures those price levels. Okay, that's why you see them in bracket. So instead of straining your eyes to look out for where the price is, the fib level is touching on the price line, just look at what is in the bracket. Whatever is in the bracket is what you put as a preset. Okay, so if you wanted to set your entry level at 38.2% fib level, then you would set this as your preset for this coin, which is cake. If you want to set your entry point at the 50% fib level, that means you will have to set the 3.196 as your preset. And same applies to the 61.8. Now, if you set your preset at 38.2% fib level, for safety purposes, or for purposes of taking advantage of any eventuality that the market price dips below your entry point, you should measure this distance from 38 to 50% fib level and set it as your margin call drop for the first call. And then you equally do the same for from 50 to 61.8%. The percentage you get there would be the margin call drop for the second call. And you can go as far as establishing the third and the fourth by measuring this distance to the 78.6, and then finally the distance from 78.6 to 100%, that latter part. Why are you doing this? Because you're not very certain. Because when the price is pulling back, there are two possibilities. Either it will reverse upon touching any of the three price retracement level or fib levels, or it will actually break below and continue down, which would, in that case, you will not refer to that as a retracement. It will be a trend reversal. Okay? So when the price is coming in, when the price is pulling back in this manner, it will either be supported at any of these three fib levels or the golden ratio fib levels, or if it continues to dip, depending on the situation of the market, it can decide to just come all the way down. And once it comes all the way down, it means actually this is no longer a retracement. It is a trend reversal to the downside. So because you're not very sure of what is happening, you just came across a market price that is dropping, and you have your 38.2% fib level still down. What you do, set your trap around there. Let the price come back or pull back to your 38.2% fib level. Once the robot buys, then if it reverses at that point, it is well. But if it doesn't reverses immediately and then continues to dip, if it drops to the 50% fib level, it will buy again. You have nothing to lose. Same applies to if it continues dropping to the 61.8, still it will buy. It will continue buying for as long as the price is dropping, right? That is the beauty about it. So you have nothing to lose there. You are taking advantage of any drop in the market price. Okay, or your robot will be taking advantage of any drop in the market price all the way until a point where the reversal will again become certain for an uptrend. Then that's when you'll have you see yourself beginning to enjoy some profit. Okay, so that is what you do. Now, I have to give you this hint that most of the times, how you can tell that the price is not actually the pullback is not a pullback that is intended for a retracement, but rather a reversal, is when the price comes and breaks completely below the 61.8, and then it is at 78 at this price level. If it is at 78.6%, or if it comes to 78.6% fib level, that is the point you should now be certain that this is no longer a pullback, but rather a reversal to the downside. So it means the trend is no longer going to maintain the previous direction, but rather a change has already been exerted in the market. So definitely now the price is no longer going to go up, but rather it will go down. That is how you ascertain a trend reversal to the downside. But for as long as the pullback is still within these key areas, you can still have some level or degree of confidence that whatever is happening is actually a pullback, not not a reversal, because the pullback can happen at exactly this level or this area. It can happen at 50 or an area between 50 and 61, or it sometimes even dips to an area below the 61.8. But the moment it touches 78.6, count it a trend reversal. It is no longer a pullback. All right. I hope that is clear. I hope that hint is clear. Is that hint clear? If it is clear, let me see a yes on the chat if it is clear. Mm-hmm. Yeah, we shall go to the chat. So that is just a demonstration. We're going to go live on the chat. Mhm. We're going to go live on the Sujata. We shall go live. Don't worry. So that was just a picture that I was trying to paint. Okay. Mhm. I but sometimes I do feel I don't know. Sometimes I do think that this is the thing they normally share every morning. Some people really make it appear as if it is very new. They make you wonder whether it is really new or what, or they just don't attend class, or they attend and they just don't pick it. I don't know. Some of those comments just makes you wonder if the whole thing is appearing new. Okay, so let's come back. Uh, let's come back here. Okay. Oh, so let's look at in a chart. Let me see. Okay. Let's come back and see. This is a good one. So I'm going to let's look at this area. We're going to capture a mini movement, and this is my area of concentration of focus. I'll focus on this area. Let me focus on this area. Let's monitor these movements. That's a minute. Let's focus on this. I want to do it live. There's a live movement here. Okay. Okay. So this is the area that we are going to focus on. Now, if you can see this movement, this is actually we had this movement. We are actually monitoring this movement. I believe we see this movement. Now we are pulling back, right? We are pulling back. Now, we are pulling back. We don't know where the market price is going to pull back from, whether it is a pullback or a trend reversal to the downside. We are not sure. But this movement is sure that from here to this point, it was a surge. So we believe that this movement here to this one was a 100% movement. Now the price is trying to gain stability. The market is trying to gain stability. And that's why we're seeing a retracement building up. Now, this retracement here, we are not very sure at what price level. Okay? Are we most likely going to see the retracement or the pullback too? Okay? We don't know whether the reversal will be at this very same point where it is, where the market price is, or it will still continue down. We still don't know. So let's consider this movement, this live movement. So we're going to base on the previous trend or expansion to establish our Fibonacci levels. So let's pick our Fib. We're going to put it here. On the swing low, we believe this is where the price started building up from. The market price rise started building from this point, right? Yeah. So I'll put my Fib level there. And then I drag it upwards to touch on that upper part. Let me just do this. I'm going to mark it. Let's mark it. Let's mark it. This is the low, right? And then that is our swing high here, right? So that is our movement from here all the way to there. So I'm going to pick my Fib retracement tool. I'll put it on the low. Since I'm basing on the previous trend, which was a rising trend, I'll drag it upwards to that upper line there. So when I do that, I think I now have something clear. Do you see the areas that has been captured? Okay. So we have the Fib levels already established. Okay. From here, and then we have that. And then in between, we have the 28.6, the 38.2, the 50, and 61.8, and 78.6, and then this. So we have these Fib levels already established. Now, this Fib level established are actually our price reaction levels. They are price reaction level. This line, if we are to extend it so that we allow it to run horizontally, we shall realize that this line is actually going to be touching on those previous price levels where the candlestick touched. Okay, we shall ascertain that it is a real price reaction level. So let me just try to do that, and we see. We'll see if we can have something there. Come to the settings, extend right, extend left, and we go there. Now I'm going to go back. Go back. Do we see this? Do we see this? Do we see that the candlestick is actually touching on them? Like, let me begin from this point. You see here, the high of this candle touched on the 50% Fib level. Ooh, and then it touched there before pulling back to this lower fib level, right? Do we see that? So it's very important. We can see multiple touch on the 78.6% fib level. When the price was trading, it comes and touches there, it gets rejected. So there was multiple touches here. You see that? Now to even be more clear, this is 1 hour time frame. Let's go to a 15 minutes time frame and you see how it will appear. This is 15 minutes time frame. See? See these different touches? Literally, the fib levels have helped us draw the trend line, the support and resistance. You see this rejection here? See this rejection? See this rejection? The price had multiple touches. You see? So this was acting as a very powerful resistance when the price was below it. And this one here, it is the 61.8, which is acting as a resistance there. So if you check through all the way, as you go back in history, these are key price reaction level. Look at this. See that? The 38.2. It's key reaction level. Okay, this area. So all the way, if you just check through, you realize this, what we have drawn is actually a very key price reaction level, right, in history. So that said, what the price is doing is it is retracing. And from the retracement point of view, we are realizing that. So let me put it here like that, okay? We are realizing that the price has actually moved by 100%. Now it is retracing. And we said there are 3 key retracement levels. Let me just make them clear. Let me put them clear so that we know them. Let me remove this. And then let me remove this so that we remain with those key retracement levels. So the first one we said is 38.2, 50, and then 61.8. These are the key price retracement levels. So in the look of things, the price has dropped below the 38.2. So we wouldn't take that as the retracement level at the moment because the price has dropped below it. Our eye now is at this 50% fib level, or the space between the 50 and 61.8, or even 61.8. So it means now, if this price drops to 61.8, we are going to base on this as the retracement level, or the pullback level. That the price is dropping to this level. Upon touching the 61.8, we may see a reversal to the upside. So meaning, in this case, if you want to use a preset, if you want to enter at a preset, this is where you're going to take this, the 61.8% fib level as your retracement level. So set your entry price at 2.6599. All right. Then do this, measure that distance from there to either this point or even back to this point. But because you are not very sure, because there's what we call a failure swing in the market, sometimes the price, depending on what the intention of the smart monies are, sometimes the price may rise, but it may not come back to the very resistance level. It may come and stop midway. All right, there's this scenario I want to demonstrate it. The scenario is what we call failure swing, that if the price, upon touching a particular price level, tries to rise, but it will not come back here. Because once it comes back here, 2 things will happen. It will either be rejected or it will break structure. However, sometimes it comes just midway to this point without reaching the previous resistance, and then it reverses and begins moving down. So this scenario is what we call a failure swing in the market. Okay, it's a failure swing. So since we don't want to be trapped under that scenario, what we're going to do is there is this other last fib level, the 23%. That is the area or the price level which in most cases we should take our profit to, or we measure our profit to. Okay, measure the TP to the percentage. So meaning if you decide to enter at that price level, which is the 61.8% where the market price currently is, you measure from there to around there. I am assuming that that is where the 23% fib level is, right? Around there. If I can bring it back, just to be sure. Let me take it back 23.6 and we'll see. Yeah, around here. It's here. That is 20. That is where the 23.6% fib level is. So that you don't get trapped by the failure swing scenario, right? So that is the percentage. That is how you're going to measure and get your take profit percentage. Then, since you have made entry at 61.8, now in this case, this will be current price. You're entering at current price. So measure this distance to the 78.6% for your first margin call drop. And then you do the same from 78.6, okay, to the lower line for your second margin call drop. As simple as that. Now, let me bring back this. The 78.6 level. Yeah, let's put it there. That is where it would be. You see, that's how you'll establish your margin call drops, right? You'll establish your margin call drop in that manner. Now, what we are doing here at the moment, remember the idea is you draw, you do your analysis, draw whatever trend line you want to draw, put in whatever indicator you want to put. If at that time after placing in your indicator or drawing your trend lines, and then you find that the price is still not, the direction of the market is still not very clear, it is okay. Just leave it there. But the beauty is, through what is happening here, you are at least very certain that this, if it passes, if it has gone below the 38, you know this will be the level. If it goes below the 50, you know this is the level. Now, if it goes below the 61.8 and it comes and touches on the 76, just know that this trend is no longer a pullback. It is no longer going to have that kind of movement, but rather it will just pull back slightly, okay, and then go down. All right, it will pull back slightly and then go down should it touch this fib level. But as long as it is still at 61.80 area, between 61.8 and 78, have some level of confidence that the trend is going to go what? Is going to go up. Now, the real thing that will give you more confidence is now when you add in an indicator like what we looked at yesterday. Now you're adding in some flavor onto your analysis. You're bringing in the stochastic. You want to see what is the direction of the market like? What is the trend saying? What is the stochastic RSI saying? It is telling us that the trend is actually in the verge of going downwards. That's why we're seeing this kind of scenario. It is pointing downward. The moving averages on the stochastic RSI are pointing where? Downward. So it is telling you there's a likelihood that this price here may not be what? A reversal, unless something happens, unless otherwise. It may be a downtrend. Okay? So that's why now the aspect of establishing margin call drop becomes key. All right? Yeah. I hope that is clear. You mean you can't hear me? Mm-hmm. Okay. It is clear. It is clear. It is clear. And since it is clear, we would say we're good, right? We would say we are really good. So you can do your analysis in the. I've always not been specific about time frame, but it's always good to make analysis on a higher time frame and look out for those entry opportunities in a lower time frame. But also at the same time, there are other entry opportunities that presents themselves on the very same time frame you're making analysis from. So if it is clear, why not? You enter, right? You make entry. There's no problem there. There's really no problem. So the time frame really is not something that you should do worry yourself about on which time frame to make entry from, which time frame to do analysis. The best is do analysis in a higher time frame, then see if at all there's any opportunity presented in the very same time frame you're making analysis in. If it is not there, go for an earlier entry and look again through a lower time frame and see if there is any being presented. If it is not on both sides or on both time frames, you're not seeing any clarity about the market, that's when you relax. You leave, you go to another coin. Okay, you don't force it. You really don't have to force it. If the market is not clear, the direction is not clear, things are not very clear, you relax. Leave that coin, go for another. Remember, this coin is defined in terms of volatility and movement. So leave that one, go for another. Do the same. If it is not clear, if you check 3, 4, 5, and they're also just the same, then you don't go to them. Just relax. Don't go and trade. You wait. Do other things. Go and do other things. You relax until the market stabilizes. Just leave whatever you've drawn on the chart. Let it be there. Come and check at a later time. Maybe after an hour, come and check what has happened. Probably you will have something clear now. That's when you will decide on making entry. But for as long as you're doing an analysis and you see things are not clear, it is not a must to trade. Only do that if you can. Do that if you want to, right? So that you don't trade because of emotional out of emotion or because of some pressure. You want to make money, you trade when things are clear. Okay? Yeah. So I hope it is clear there on my side. I think that is enough for me for today. At least I've tried to incorporate in the two. I told you, add in the other to just have a clarity about the market. Now you see, we were fidgeting, we were seeing, we were thinking as to whether it is a pullback or a retracement. But the stochastic RSI was clear to tell us that the trend is, it's the market price is dropping. Yeah, it's going down. So probably we first relax, or if you want to enter, you enter, but then have margin calls. That's all. So that is it. Unless otherwise, unless there is a question, but I believe that should be sufficient for you. All right, that will be sufficient for you. So what you only do, continue learning, continue continue learning. You are saying that the fib moves from 0 to 100%, but I see you moving in from. Okay, let me do this other version. We didn't do that on a down on a downtrend, right? Let's check. Let's check for a scenario on a downtrend. Let's check for a downtrend. Let's look out for a downtrend market, right? I'm going to check for any coin I see. ACR. Let me look out for it. Okay. Is this clear? Okay. Let me do this. Let me check on. Let me use this one here. Let me use this. Let me capture this movement for this coin. because at least I have an established downtrend, right? And then there's this reversal, there's this attempt of the market price pulling back. So in a downtrend, you connect a swing high to a swing low. In an uptrend, you connect a swing low to a swing high. That's the difference. That's the difference, yeah? Hey, that's the difference. So if that is true, then that means we're going to connect our swing high to a swing low, like that. Now, in a downtrend, ladies and gentlemen, in a downtrend, this is what normally happens. Let me first delete this. In a downtrend, what you're looking out for is this. What is this? Just a minute. Okay, here we are. Now, in a downtrend, we are capturing a 100% movement, right? And in the course of a downtrend, when you're capturing a downtrend, since you're connecting a swing high to a swing low, that means the price was actually, dropping, right? It was dropping, it was falling. From 100, it is coming back to 0, right? So it has moved from 100 to 0. I hope that is clear. It has moved from 100 to 0. So it means that this was a 100% movement. Upon attaining a 100% movement, there would be a retracement, and retracement would still apply. The retracement level still apply. You either have the 38.2, the 50, or 61.8. Now, what you should expect is that as the price is pulling back or retracing, it may have 38.2% as the rejection level. So meaning if it rises to it, it may reverse to the downside, or it may surpass the 38 and goes to the 50 before having that movement, or it may even go as far as 61.8 before having that movement. However, in a scenario where the market price goes to 78, irrespective of what the pullback is going to be, expect the price to go back and hit 100%. It means this is no longer a pullback, but rather a shift in structure to the upside. For as long as it touches 78.6, just be rest assured that the price is going to come and touch your 100% level again. So that is what happens. Now, in a scenario where the market price pulls back to 38.2 or 50%, and then it comes down and stops midway before reaching this support level where it previously touched, we will encounter what we call a failure swing. This is also another signal of a trend reversal to the upside. Okay? It shows that it indicates that the trend is reversing to the upside. So you'll have the price dropping to that level, retracing back or pulling back to 38.2%, tries to come as if it wants to continue down, and then immediately it reverses and comes and breaks this structure, this level. That is a trend reversal. Hey, is that one okay? Yeah, we I hope that is clear. Yeah, so I hope that is clear as well. Now the last bit is when when you are trading in a downtrend, okay, what you're going to be looking out for are only these two scenarios. The pullback, let me share this. Should only look out for this scenario. The first scenario is if the price touches on your 0%, like it has done, and it is pulling back, right? You can make entry and take profit to this 38.2. If you find that the price is moving above 38.2, if you want to enter at current price, measure from there to 50%. If it goes past 50%, measure from there to 61.8. Now, at the moment where it passes or it goes above 61.8, then take profit to 78. Now, if it touches this, take profit to 100. Just trade within the different Fibonacci levels. Take profit within the different Fibonacci levels. But what I want to guarantee or assure you is a moment the market price rises to 78.6, be rest assured that irrespective of whether it pulls back to whatever level, it is going to come back and hit your 100%. So this would be a reversal to the upside. That is what it will signal. Okay? That's what it will signal. Okay, so I hope that is okay. All right, so I think that is sufficient for us for today. I hope it is clear. Yeah. So if there's nothing more, we could end here for today, and we catch up again. Now, this these classes, you need to, if you do not understand, I think it is always being recorded. You can visit the Crypto Ambassador group, YouTube channel, and then you go and watch. You rewatch. You rewatch. Yeah, you rewatch. Yeah. Okay. So I think we shall end there for today. This week we should be important to conclude what I had prepared for you guys, and then probably next week you won't see me. You won't see me next week. I'll also be doing other stuff now, personal and team things. I'll be concentrating on the team also, my team. So probably another leader will come on and try to share, probably repeat the same thing also. And you may have a better understanding if you didn't get it from first hand. Okay, so have a blessed day, guys. See you tomorrow, where we shall be looking at another indicator and see how we can use it as well. Bye-bye for now. Yes, Doris, goodbye. Bye, Doris. Bye, everyone. And I appreciate the love. Appreciate everything. Thanks for always being there. Good team members. All right.